You sit down with a client, they've done everything right, saved consistently, invested prudently, built a diversified portfolio. And then they say, I thought bonds were supposed to be the safe part, so why did they go down? Not a little, a lot. For decades, the story was simple. Stocks equals growth, bonds equals stability. But over the past few years, the story has felt off. 2022 happens, stocks are down, and bonds also down at the same time. So now the question becomes, if bonds can lose money too, what are they even for? Today, we're walking through what bonds actually are, what went wrong recently, and why, despite all that, we still believe they play an important role in a well-built portfolio. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, here we are for an episode of Plan to Prosper that we're both very excited about.
Oh, yeah.
We're going to be talking about everybody's favorite subject, bonds.
The fixed income.
Yeah. As you said right before, this is the least, I can't think of another word other than the one you actually used, but I didn't really want to use it on the podcast. But I'll use
Appealing?
Appealing. There we go. That's a good one. The least appealing aspect of some financial investing. But I think this is going to be a fascinating episode, personally.
I hope so. I hope we can hold listeners' attentions.
Yeah. I think it's a natural question to ask when looking at the past few years in particular, if you don't have a broader historical context in mind, and maybe you just started investing a couple years ago and you go, what's the point of this in my portfolio? It doesn't seem to be doing much. I think we're here to try to address that, what our conviction is about bonds, what they are in the first place, and why we still think they should be a part of a good, well-diversified portfolio.
Yeah, I should have looked this up. I think I wonder if I can real fast. I think if you look back like the past 5 years and just kind of overall aggregate bonds, I think the returns are still pretty flat on an average basis if you're looking back 5 years. So yeah, to your point.
Because that would still include 22.
Yeah, that would include April of 21 or May of 21 through.
What has it been since like January 23 to today?
It's done 23. Yeah, it's done a lot. It's actually done pretty well. Because last year I think it was up like 6. The year before I think it was a similar 5 to 6. So much better if you don't include 2022. And yeah, if you look at the 5 year, up 1%.
Okay.
Cumulatively.
So. Not great.
3 year, up 5.26%.
There we go.
So, yeah, if you get
2022 just crushed it.
Or no, sorry, that's 1 year. 3 year
in the bad sense
is up 11.26%.
No way.
Yeah.
Wait, 3 year?
3 years up 11.26%. 1 year's up 5.26%.
Okay.
5 years up 1%.
So what was 2022? How it was like net down double digits, right?
Yeah, it was. I think at one point it was down like 13%.
Yeah. So we'll get to that, what happened in 2022. But I guess let's start at the beginning here. What even is a bond?
Basically, it's a loan. There are different entities that you can provide a loan to. Probably the easiest way to explain it is a company needs financing for something, some type of growth initiative or whatever it might be that the company needs or would like to complete. And so the company will go to the general public and say, hey, we'll issue X amount of bonds. And so you pay us, say, $1,000. And in return, we'll pay you 5% annually or whatever the going interest rate is at the time. And you will get all your principal back at whatever that maturity date is.
So a company might do this to preserve liquidity so that they're not, like they might have the cash to fund whatever project they have, but they could drain their liquidity.
Right.
And they don't want to
destroy their balance sheet.
Right.
Yeah.
And so a bond will help them fund this initiative that they could expect a greater return on. This isn't like a bad deal for them where they're like borrowing cash and then they have to pay back more in return, and that's kind of the end of it. They're funding something that will yield their own return.
At least I think so. That's the point. Yeah.
The point of it would be, in a perfect world, everything's going to go smoothly. Whatever they're funding is going to yield them a greater return, and then they can return the fund to the investors.
Right. And you'll get different rates depending on kind of the credit worthiness of the lender or of the borrower. In this case, you are the lender
Mm-hmm.
because you're buying the bond and being promised a rate and that you'll get back your principal.
So there's a few terms here. There's the interest rate, that's also known as the coupon, that you would get a bond at. So in your example is 5%. There's going to be some duration. It's not an indefinite thing. It's not like
Right.
you borrow it and they'll just pay you 5% forever. At some point they have to return the principal to the borrower.
And there can be different lengths.
Right. And so we'll get into duration and why that affects the quality of the bond itself too.
Right.
And even the yield. Like we'll get into why a high yield bond is maybe not as good as it might sound at face value.
Right.
So there's a lot of interesting things here. But yeah, what a bond is, it's a loan to a company or the government, municipalities, that they will use to fund a certain project, and they promise to pay you in return with some level of interest.
Yeah. Promise. Yeah.
Yeah.
Doesn't always work out, but yeah.
Right. That's the agreement
Yeah.
in principle.
Exactly.
And so I think the confusion exists where, okay, this is also known as fixed income because in the example you gave, you put $1,000 in, you get $50 a year for whatever the duration is, and then you get the principal back. So it's fixed.
Yeah.
Why is it then that how do bonds go down where you have a year like 2022? I thought I was if I put $1,000 in, I was guaranteed to get $50 a year and then my $1,000 back at the end of it. How does my investment go down?
Yeah, so you're right. That's exactly the case. Again, let's just say 5 years. So in the beginning of 2022, well, actually, I think I have numbers. In August of 2020, the average 20-year Treasury was yielding 1.1%. So interest rates were ridiculously low. They were ridiculously low through really the 20-teens and into 2020. And then we just started pumping money into the system and inflation went nuts. And so from 2020 through 2022, rates, late 2020, 21, rates starting to climb, and then 2022, they just took off. And so in 2020, if you purchased a bond and were promised we're going to give you 1% interest over 20 years, and then because of inflation and the rates rising, the Fed was increasing rates, which changed the kind of overall market's assumptions for what interest rates were going to do. The 20-year started climbing as well. So by October of 2023, you could get a bond for almost providing a coupon for almost 5%.
Mm-hmm.
So if in 2020 you bought a bond that was providing a coupon of 1%, and in 2023 you get almost 5%, nobody wants to buy your bond that is yielding 1%. So the price just keeps falling.
Yeah.
You've got to make it appealing for an investor to buy a bond that's still yielding only 1% in order for them not to want to buy the 5% bond. So to do that, you've got to change the price so that, in essence, they're still getting 5%. It's just not 5% in interest. 5% annually. It's not 5% annually in interest payments. It's 5% on their overall investment.
Interesting. Okay, but if you were
Did that make sense?
I think so. If you were to just hold that 2020 bond at 1% for the entire duration of that 20 years, you still get what you were promised. Or agreed upon.
Yeah. So price is going to go down in 2023, but if you hold it for until 2040, that price is going to keep going up until 2040. And so in 2040, assuming there's no defaults, you're going to get all of your principal back, and you would have gotten the promised 1% interest rate so you wouldn't have lost anything.
Mm-hmm.
But price goes down because the market has changed.
So in some ways, if you're not buying and selling, like it functionally, is this similar to buying and selling stocks when you're considering the value of the bond itself, as opposed to just a buy and hold strategy? Like, I'm buying this bond with the expectation that I'm going to hold it as if it's like a CD and wait till it matures, not with the goal of like, oh, now I'm going to sell it to get into another bond with a higher yield, because you'd be taking a loss at that point if it's going to do that, right?
I'm not quite sure I understood the question.
The idea of the fluctuation of the price of the bonds, it has a bigger impact if you're treating it almost like a stock, where if you're selling it before it reaches maturity.
Yes. Yeah, it's more like a stock if you plan on trading it, not holding it.
Right.
Yeah.
Right. And so, in theory, if you have a bond in your portfolio that is decreasing in price, but you're still just holding it, you're not actually functionally losing out, because you will get that money back. That's where I think the confusion potentially lies. Is like, I bought this for $1,000. Let's keep using that example, but now it's saying it's worth less than that. Yeah, right. Yep. But I'm still promised to get that $1,000 in return.
Right. At
the end of this.
Yeah.
So, like, don't panic.
You just can't sell it for $1,000 today.
Right. Just hold it.
Yeah.
It's like,
it's all basically what your intention is for the bond. If all you need is that 5% interest payment, then you're in fine shape.
Yeah. Now the opposite can happen too, right? Where the value of the bond that you bought actually goes up.
Yeah.
And so you have an interesting decision there, where it might feel like a good opportunity to sell your bond.
Yeah. Right now there are bonds in the 6, 7, 8% range. There's even, as you get into junk, high yield, I think is the more well-known term now. High yield, and then even kind of the private credit, you can get into potentially even the low teens. So yeah, kind of you have to weigh and balance whether or not you want the interest payment, or you just want to take that gain. Yeah.
It's an interesting conversation.
Yeah.
So in essence, there's an inverse relationship between interest rates and the value of the bonds. Yeah. So if interest rates go up, whatever that bond value was probably is going down.
Yeah. Yep.
And vice versa.
Right.
So I think another clarification would be, a lot of people probably aren't buying, maybe some are, individual bonds for specific companies, but rather are getting into bond funds.
Yeah.
So explain the difference there and what's going on here.
Yeah. So bond funds, they're like stock funds. There can be different kinds. There can just be kind of the passive, what is the aggregate of the bond market index doing? Or you can get a little bit more active or a little bit more specific, like I only want short-term, or I want long-term, or I only want government bonds. Or you can get active with using managers with a broad mandate that are basically looking at the markets and deciding where they see the best opportunity and potential. And they can move from maybe a shorter duration to a longer duration, or they can move from a high credit quality to low credit quality. And so basically they're looking at bonds as investments and deciding when to buy and when to sell, and not necessarily using it as we're just going to buy and hold because we want that 5% annually for 10 years or whatever.
Right. So there's no maturity date on the fund itself. You could buy a bond fund and just hold it forever.
Yes. Yeah. There are some that are, I think they're called bullet funds, where it's like a 5-year. So if you buy it, you're intending to get that interest rate for 5 years, and then it resets at the end of that 5 years. So there is that type of bond fund as well, but the majority of them are not that.
Okay. And so this is where the value of those bonds really kind of plays into how it's impacting your portfolio, because it's still acting as fixed income in your portfolio, because you're still receiving payments throughout it, right?
Yeah. Yep.
But
they can change. Okay. So it's not fixed. It's more income, less fixed.
Okay, got it. Yeah, I guess that makes sense. If they're kind of always being swapped in and out by whoever's managing the fund. And so if interest rates are going up and bond values are going down, that will have an impact on your portfolio, because you don't really have the ability to control whether or not I'm just going to hold this one bond until it reaches maturity and just get my money back.
Right.
That's not really going to happen there.
Yeah, correct.
Okay. And so when people usually say my bond lost money, they're probably talking about bond funds as opposed to an individual bond that they bought. Yeah,
the typical person, although
unless they sold it, but
you can look at we've had clients look at their statements and say, hey, why is this bond down 10% or whatever? So you can't look at an individual bond and say, oh, why is it down?
Yeah.
But the majority of people that are investing in bonds are using funds.
Yeah. So if bonds are loans, what? I guess you already did explain why they lost money. I guess we don't need to go into that question. So let's set the stage a little bit. Let's rewind the clock. We've touched on it a little bit, but like what? Let's go pre-2022, and then let's get to that big year, the huge downturn in 2022. But let's look at what happened before 2022. Explain what was happening with interest rates and bonds before 2022.
Yeah, so interest rates through, how far back do you want me to go?
As far back as you want to go. Whatever would be most helpful.
All right, well, I guess I'll go way back. So early 2000s, you could easily get bonds in the five. I remember buying my first CD before I was even 18. And it yielded like 5.5%. So you could get.
Are CDs and bonds similar? Do they
yeah,
correlate?
It's basically a bond from a bank.
Okay.
Where I think it was a 12-month CD. I gave the bank $500 or whatever, and I was promised 5.5% back. I don't remember if I got interest payments or I just got 5.5% back at the end of the term. But yeah, it's similar. In order for the banks to do it, they're buying treasury bonds from the government.
Mm-hmm.
But so you could get higher yielding than post. You get 5.5%, 6% in early 2000s. And then the great financial crisis happened. The Great Recession happened, and there was really weak demand, low inflation, and the Fed, when the markets fall and that kind of economic environment occurs, the Fed cuts rates. Fed cut rates to almost zero, basically, essentially. It was effectively zero. And so they do that to kind of try to stimulate the economy. They don't want people saving as much. They want people spending more, and they want to make it easier for companies to borrow so that it's more of a stimulative environment. There's more cash in the system.
Mm-hmm.
Through the 20-teens, there really wasn't a whole lot of inflation. So again, the Fed was keeping rates at almost zero. And then COVID happened, and nobody was buying anything, or nobody was going anywhere. So again, stimulate the economy. They were actually pumping money into the system, printing more money, so that they were trying to stimulate just economic growth post-COVID, and they just printed massive amounts of money. Part of that was also because of some kind of legislative bills and like the COVID relief payments, things like that.
Right.
And when you print that much money, inflation can run rampant. There was famously the Fed said that, I think when inflation started to climb, they were saying, oh, it's transitory. So it's just temporary. It didn't turn out to be temporary.
Mm-hmm.
So in order to control the inflation, the Fed had to rapidly raise rates.
Right. And as we already discussed, when that happens, what happens to the price of bonds?
They fall.
Right. So if you bought a 2% bond and suddenly interest rates are at 5%, nobody wants that bond.
Yeah.
What's it called? I forget. It's been too long since I've studied this. What's it called when a bond is selling? Let's call it $1,000, but now it's worth $900, and you
like the par value.
Yeah. Never mind. So if that happens, if somebody bought a bond at $1,000, put $1,000 into a bond, and the value goes down to $900, and you buy that $900 bond,
yeah,
will you get $1,000 in return plus the interest payments on it?
Yeah. Yep.
Okay.
That's why you're effectively getting the same thing that the current bonds are going for now. So if you're buying a 2% bond, but rates are 5%, nobody's going to do that unless they can effectively create a 5% return.
Yield, right?
Yeah.
Yeah, it's interesting. So yeah, nobody wants to buy that 2% bond if rates are at 5% unless it's cheaper, and you can essentially make up for that.
Right.
So then, all right, let's go to 2022, kind of the climax of this drama.
Yeah.
What happened here?
I mean, rates just went nuts.
Skyrocketed.
Yeah, the Fed rate went from almost 0 to, I think it peaked at like 5.25. Might have even been 5.5.
Okay.
So yeah, just in very rates increased extremely rapidly. I think it was the fastest increase ever. It was 2022 was the worst year for the markets in general. So when you combine bonds with stocks since I think it was the 1860s, just because typically people don't want bonds and stocks to do that.
And why did that happen? Like, why did stocks also drop so dramatically? What was happening in the economy that led to that?
It was just there was a lot of uncertainty. There were 2 quarters of negative growth, which now I can't remember which governmental institution has to declare recession. Historically, if you see 2 quarters of negative growth, it's a recession. But now some government entity has to declare it, and they didn't declare a recession. But because of the negative growth and the rampant inflation and the uncertainty, stocks were going down, but that was also causing bonds to fall.
How does 2022 compare to 2008 in terms of the fallout and the impact economically?
Overall, well, 2008 was much worse for stocks, but bonds had a short blip where they fell a little bit in 2008, but in general, people were fleeing stocks and going into treasuries. So there was a decent there was negative correlation between stocks and bonds in 2008. 2022, we didn't have that negative correlation. We had positive correlation. Again, first time since the 1860s or whatever that both stocks and bonds were down by negative double-digit returns.
Mm-hmm. And then kind of post those years, 2008 seemed to have like kind of, the great, the financial crisis of 2008. Do people talk about 2022 that way? The great financial crisis of 2022? It doesn't, like it was a bad year, but 23, 24, 25 were pretty good years on the opposite side of it. So
yeah. I don't think they do. I think part of that is because the equities came back
pretty
quickly after 22. Bonds didn't come back as well, but again, the less appealing thing that people watch in the financial markets. Unless you're a retiree, most people aren't. Oh, what are the bonds in my portfolio doing?
Yeah.
So I think that's most of why people don't refer to it in the same way. But it was a massively terrible year.
Yeah. So I think one key thing to point out, we talk about there's different risks. Everything in life has risks to it. And there's different risks at play in any financial move that you make. Holding everything in cash, we've talked about this before, is a massive risk. Mm-hmm. There's inflation risk here because you're just going to lose out to inflation when you're holding it all in cash.
In 22, we hit 9% inflation.
Right. So you've just lost out a lot. The buying power of your dollar that's safe in cash has really dwindled.
Yeah.
And so bonds have their own risk associated with it. And I think the primary one would be interest rate risk that
definitely for government bonds, yeah.
That just went crazy in 2022.
Right.
With the Fed doing what it did.
Yeah.
And that was kind of it all showing up at once, this interest rate risk exposure in bonds. When you buy that, though it feels safe, that is unfortunately the one of the risks that you run with bonds is a crazy period of inflation that the Fed raising interest rates. So that's kind of how it showed up there.
Yeah. That's an interesting point. That's also why equities went down, because as the Fed's increasing interest rates, investors are discounting the future cash flows of companies at a higher rate, which lowers valuations.
Okay. Interesting. I think in hindsight, was there anything predictable about this? as kind of going from COVID in 2020, seeing where things were heading, was there anything that could have, obviously we can't predict the future, so I know the answer to the question, but was there anything leading up to that you were like, you could see the bond market might be due for a bit of a downturn here?
Yeah, so when that much money is pumped into the markets, I think it basically always means inflation. The predictable part, relatively predictable part, I'm saying predictable because we kind of predicted it, was that rates were going to go up.
Mm-hmm.
The unpredictable part was how quickly they actually went up.
Yeah.
When the bonds that we were managing, we drastically decreased duration in very early 22, I believe it was. It was late 21, early 22. We drastically decreased duration. So bond market in general was down 13, and the bonds that we were managing were down 7 to 9, depending on the portfolio you looked at. So hindsight's 2020. The investors, some people came to us and said, "Well, why were you in bonds at all?" We didn't. You can't take that much of a risk and just pull out of bonds. Retirees need some type of income, things like that. But there were predictions that you could make to at least make the down not as bad as the overall market.
Okay. So, with that little bit of historical context, let's talk about then what are bonds for? You shared that a little bit. In retirement, a retiree needing some income, bonds will provide that. What is our conviction at Stonecrop, and for what role bonds play in our clients' portfolios?
Yeah, so there can be a couple different things. It can be for income if somebody needs the income. If retiree needs X amount, whatever. It can also be just for more stability in the portfolio.
Mm-hmm.
So some people, depending on their risk appetite, can't stomach just stock investing. In 2008, not many people could stomach 45% negative returns in stocks. So it's a way to make risk less, to lessen risk in the portfolio. Traditionally, bonds are supposed to negatively correlate with stocks. But even when they don't, it's not often that they're down by double digits.
Yeah.
So they could be down 3%, they could be down 5%, and then come back the next year. So it just provides more stability in the portfolio. And it's also a way that you can manage them as investments and provide positive return, positive alpha when comparing to traditional bonds.
Okay. There's diversification at play here too, where we're not just heavily concentrated in stocks, but allowing for, like you're saying, this negative correlation between stocks and bonds. 2022 being the exception, not the rule,
right,
that this is all gonna tank at the same time. That was a historic year, and in the years that followed, I think that's kind of proven itself. I mean, we haven't had obviously it's only been a couple of years, but stocks have been doing really well, and even bonds have been doing well.
Yeah. And there's heavy diversification in just a bond investment as well. Because
a single bond fund, you're saying?
Well, then a single bond. But like people think diversification in equities, and they think U.S. and international. You can do that in bonds as well. Small company, large company, you can do that in bonds. With bonds, you can even get into different types. So some bonds are just backed by the company. Some bonds are backed by a specific asset. Some bonds can be backed by some type of collateral. So it could even be backed by like credit cards are backed by the credit borrower.
Okay.
So yeah, there's a vast array of different types of bonds that you can get into, and they perform differently based on the environment.
Yeah. Explain duration as it relates to the value of a bond, and why a shorter duration would be in general gonna do better than a longer duration bond?
In like 2020?
Just explain in general the role of duration in a bond.
Okay. Yeah, I meant 22. But yeah. So duration is going to make bonds, all else equal, more or less risky. So lower duration are going to be less risky because of basically there's less interest rate sensitivity, and it I think intuitively makes sense, because if you are holding a 2.5% bond, 20-year bond, and rates go to 5%, now all of a sudden you're only getting 2.5% over 20 years when you could have gotten 5%. If it's a 2.5% bond for 2 years, then you're only losing out on 2 years of 2.5% interest. So kind of, again, all else equal, duration, the way that you can kind of approximate it is that for every 1% increase in interest, your bond is going to go down by the duration. Okay. So if you're holding a 20-year bond and rates go up 1%, time plays a role in this. But so if it goes up 1% overnight, your bond is going to lose 20%.
Right. Yeah, that makes sense, because you've got 20 years of an extra 1% that you're missing out on.
Yeah. Yep.
That makes sense. So shorter duration is a higher quality bond.
Not necessarily.
Oh.
Because you can also look at credit quality. So you can have AAA government bonds that are 20-year, and so the U.S. government is considered like almost risk-free. Now, it's not considered as risk-free as you go out on the spectrum of time, of duration, but the U.S. government is looked at as with a much higher credit quality than small company in the U.S. that might have. There are credit rating agencies that determine credit quality based on a number of factors. So traditionally, U.S. government bonds are in the A's. I can't remember who rates U.S. government what. Occasionally, you'll hear about a credit rating agency that's decreased the credit quality of the U.S. government, but overall, U.S. government is always investment grade, and then there's also junk or high yield, and so those are considered less credit worthy. Mm-hmm. So even if it was a 2-year, it's probably
still risky.
It's probably going to pay a higher interest rate than a 20-year government bond.
Right. One of my favorite Adam Sandler movies is The Wedding Singer, and there's this scene. The antagonist in that movie is Glenn Guglia, who is engaged to the girl that Adam Sandler is in love with. Okay. Drew Barrymore. Have you ever seen it?
Yeah, but it's been like 15 years.
All right. So Glenn Guglia, when he meets Adam Sandler's character, Robbie, he says, Robbie goes, well, what do you do for work? And Drew Barrymore steps in, and she goes, he sells junk bonds. And he corrects her, and he goes, high yield bonds. And this guy's a really sleazy character. And I remember just hearing that, and like I had no idea what that was, because I probably first saw it when I was a teenager. But it's funny in hindsight, this really sleazy character is selling high yield bonds, which sounds good when you say it that way. But when you call them junk bonds, it doesn't sound as good.
They sound terrible.
Right. And so, yeah, the idea is, as you were saying, the U.S. government is a good example, kind of the default risk is lower there,
right.
Whereas a high yield bond, it's a riskier company that is, less stability. It's a weaker company that needs capital, so they have to offer a higher interest rate in order for it to be in any way attractive to somebody. But the default risk is a lot higher there.
Yeah, if they declare bankruptcy, you're not getting your principal back.
Right. So you can kind of compare it to like lending money to a friend. You've got friend A who's got a good job, a responsible person, and you lend him some money, and you just, again, we'll take the idea of usury out of this, but we go, yeah, you can just pay me back 3%. That's fine. I trust you. I know it's going to be fine. Then you got friend B who's kind of a wild card. He doesn't have a stable job, but he's got this new idea for this thing that he wants to do, and you go, all right, I'll lend you this money, but I need 10% back here.
Yeah.
If I'm going to take this risk. So it's kind of the same thing with high yield bonds, junk bonds. That's why they're called that. They're just a little bit, they're more risky.
Yeah.
In spite of a higher theoretical return. Mm-hmm. So yeah, there's like investment grade bonds and below investment grade bonds. That would be kind of below investment
Junk
grade.
or high yield.
Yeah. What are some other mistakes people make with bonds? So there's chasing yield, so going after the junk bonds because, I can get a 10% yield here.
Yeah, you might not.
Without considering the risk involved. The duration thing, what other risks are involved with?
There's recency bias, which we see now. Like, why buy a bond if, like, in 2022 it can fall 13% or whatever it fell? That's not the norm. Mm-hmm. Bonds can still play a good part in a portfolio if you're depending on yield. There's that one. Misunderstanding the difference between the bond and a bond fund. So they think, I'm going to get 3% or 5%. Let's say I want to make 5% over a year. And actually, a decent example of this is high yield savings. They're banks, but they're using treasury bonds to do it. If somebody wants 5% and they think, let me just stick it in my high yield account and I'll get 5% over a year. Well, they can start lowering that interest rate based on what the Fed is doing to
and they do.
Yeah. I think when I first got in, I was in a high yield savings. I was 5+%, and I'm at like 3.6 now.
Right. Exactly.
You can think kind of all or nothing. We kind of went over that. I'm just going to get into stocks. Well, can you handle that? If stocks are down 20%, are you going to think, no, I need to bail? I'm too scared of being in stocks.
For sure.
Yeah, maybe balance your portfolio a little bit more so you can stomach some volatility. Mm-hmm. And then there's ignoring things within different bonds and different bond funds. So bonds also have options. So you can have a 10-year bond, but the borrower has the option of calling the bond after 3 years maybe. So that will actually decrease. On paper, you're looking at it and you think, this bond has a duration of 10. Well, when you add the callable option, it's going to decrease the duration. Because if they've issued a 5% bond and now interest rates are at 2.5 in 3 years, they're going to say, well, I'm going to call that bond back and I'm just going to reissue debt at a lower rate.
Right.
So there's misunderstanding things like that. There's misunderstanding convexity. I don't really know if we should get into convexity. That's a complicated topic. But then back to the duration thing. Good example of that is Silicon Valley Bank.
Okay.
That also happened in 2022, where Silicon Valley Bank was basically taking deposits and buying longer duration government bonds. So they weren't going out on credit quality, but they were going out on the duration spectrum, and that's fine. Accounting rules make that relatively okay, but the problem was like you don't have to. Accounting doesn't require the bank to mark the price down if rates are going up until something happens. So in 2022, when it was harder to borrow and things were, Silicon Valley Bank was serving a lot of the Silicon Valley, so kind of tech companies.
Right.
And as they needed cash and they were pulling from Silicon Valley Bank, at that point, Silicon Valley Bank had to start selling their bonds, and that's when you do have to start marking them down. They need to create liquidity. They were selling bonds and they were marking them down, and then kind of Silicon Valley Bank realized what happened, and they said that they needed another. Basically, they came out and said, "Okay, we need some more funding," and that just basically created a run on the bank.
Yeah. Okay. Not dissimilar from some of the financial crimes we discussed when those were found out, when there's a run on Lehman Brothers or Bernie Madoff, people trying to pull their money out. And it's like,
Yeah. I'm
not calling Silicon Valley a Ponzi scheme or anything, but.
Well, we had a client who worked for a company where most of their cash was with Silicon Valley Bank, and he had to fund a payroll with his own personal bank account.
Oh, man. That's rough. So if a young person's listening to this and they go, you mentioned like retirees needing this a lot. what does a bond have to do with me? Like, why should I care about this? What does this have to do with what I'm trying to do in my portfolio? What role does a bond play for me in my life right now?
Yeah, so I think again, it depends. We are constantly doing kind of risk analysis on what you can, both your risk appetite, but also what you kind of your risk capacity. That's so. A bond can certainly play a big role in your portfolio if you want to buy a house in 3 years or something like that. So the lower the time horizon, the more likely it should be that you buy bonds instead of stocks, or even just high yield savings, which is effectively buying bonds. But yeah, then the risk appetite. If you have less of an appetite for risk, you need non-correlators.
Right.
So you would have things like bonds and then alternative investments in your portfolio as well.
Yeah. So if you're a young person, you're contributing to a Roth IRA, but you're also contributing to some taxable investments. You might have a strategy where your Roth IRA is like, you're young and it's largely on the growth oriented side. You're maybe not as exposed to bonds in your Roth IRA because you're not planning to pull from that until you're well into retirement is the goal. Whereas your taxable account, you kind of want that liquidity for either really specific needs like buying a house in 3 years or potential needs like, I need to buy a car that I wasn't expecting to need to buy, or I need to put this deck on my house, whatever it might be. You might want to have a little bit more preservation in mind in an account like that where liquidity is a bigger priority than it would be in a longer term retirement account that you're not planning on touching for 30 years.
Right. Yeah.
So you might have a different allocation strategy in two different accounts, even if you're the same person and you might have two different strategies going.
Yeah, that's a good point. But that's also where people can make a mistake with bonds. A mistake to avoid. If you are a retiree and you have the three buckets, the Roth IRA, tax-free, tax-deferred bucket, so traditional IRA, and taxable bucket, most people just think, I just need an asset allocation and I'll figure it out from there. Asset location also matters. So bond interest is taxed as the majority of bond interest is taxed as ordinary income, versus capital gains that has its own tax rate, typically lower depending on how much you make. So typically the goal is get all that bond type income into tax deferred accounts. Some people make the mistake of putting it in taxable.
Interesting.
Or might even not have a clue and just put it in Roth. Think, I want to avoid the taxes, so let me put it in my Roth. Well, you want your Roth to grow faster than bonds are going to provide. Yeah.
Yeah. There's also like muni bonds that are like tax free in that, and so that would be
federally tax free.
Yeah, right. So that's not a great move then in a retirement account if there's just no benefit in the muni bond not being taxed at a federal level.
Right, because muni bonds aren't taxed, they're also typically yielding less. So you're just putting something with a lower yield in a tax-deferred or tax-free asset.
Yeah. So speaking to an advisor is going to be really helpful to think through these things because you can hear things tossed out like this. Oh, there's tax-free bonds. Let me just load up on that in all of my accounts. Oh, there's high yield bonds. Let me just the language can be confusing when you hear these things without talking to an advisor and letting them explain things to you that that high yield bond that you have that might not actually be a great move for you. That's pretty risky. So,
well, yeah, because we've in our portfolios of late we've kind of created a credit barbell. Most people don't know what that is. So it's kind of bunching the credit on the short term and then higher credit quality on the long term. So there are a lot of different strategies that you can do as you're kind of paying attention to it.
Okay. Yeah. All right. Let's bring this all together. We have talked about what bonds are, the history of bonds, what our conviction is at Stonecrop. Let's kind of wrap things up now. and just kind of summarize what we discussed today. Bonds didn't break in 2022. They still have a role to play in your portfolio. It's going to differ depending on your time horizon and your goals and all that stuff. But in some level, we still have the conviction that they have a role to play in our clients' portfolios. And so that's why they're still in there. We need to understand, as I mentioned earlier, that every investment, bonds included, does come with some type of risk. And the purpose is to spread out that risk, to kind of diversify your risk so that it doesn't all fall apart at the same time. You want to spread that out so that you can kind of withstand whatever the risk that might rise up at any given time, whether it's interest rate risk or inflation risk or whatever. You're well diversified so you can kind of weather that storm.
Yeah, with the exception of T-bills, which is typically referred to as the risk-free rate.
So load up on T-bills and that's it?
You're going to get little in interest in the normal environment. Right now, you're still getting 3-ish%, but in a normal environment, you're going to get very little interest.
All right. So yes, the risk with stocks is obviously volatility and drawdowns, bonds, inflation, interest rate risks. That's all at play here. Want to address one thing that you brought up before we recorded, and the idea of, if you're familiar with the Bible talks about usury being a sin. Usury is lending out money at an interest rate, kind of to simplify it. Yeah. However, so you might hear that and go, well, that's exactly what I'm doing when I buy a bond. I'm loaning money to a company and expecting an interest rate in return on that. But I'm going to read a couple of verses that will sort of help shed some light on this idea. So Exodus 22:25 says, "If you lend money to one of my people among you who is needy, do not treat it like a business deal. Charge no interest." I'll come back to that one in a second. I'm going to read Leviticus 25. Verse 35 says, "If your brother becomes poor and cannot maintain himself with you, you shall support him as though he were a stranger, and he shall live with you. Take no interest from him or profit, but fear your God that your brother may live beside you. You shall not lend him your money at interest, nor give him your food for profit." The idea with usury is exploiting people that are in a difficult spot. Yeah. Taking advantage of desperate people. A bond is a legitimate, you're legitimately lending funds for productive endeavors. It's mutually agreed upon. It's mutually beneficial. The company benefits from it. You benefit from it. There's reasonable compensation for the risk that you're taking on by lending it to this company or this government. And so you're not taking advantage or exploiting a needy person. Right. You are going into this agreement. Both sides are totally on board with this. And in that sense, I would say that this is not in any way usury because you're not exploiting a poor person that is desperate and needs money. You should lend or give to that person, not even lend him. God calls you to be generous too. There are times when you might just need to give money to the poor. Oftentimes that would be a great move financially. Yeah. Give your money away. Don't expect anything in return, and certainly not at interest. Right. So I think that's the big difference.
What would you say about there are funds that get into SoFi loans. So what you're doing is that kind of creates SoFi loans. What you're doing is you're basically giving SoFi money to then lend out to college students. So it's more of the peer-to-peer lending than it is corporate. What would you say to that?
That's a great question. Students are still getting something in return. The whole student loan conversation, we talked about them before, but you need to be wise with going into student loans. But nevertheless, you are still getting something in return for the loans that you take out. You could be swimming in student loan debt, and it could be a terrible thing for you if you rack up a massive amount of student loan debt and then get very little in return for it. We've seen people that do that where they get hundreds of thousands of dollars in debt and they only make X amount, not even close to the amount of money they need to make to pay that back. But in a perfect world, the student loans you take out are providing you with the education you need to get a good job that will ultimately be able to support you for the rest of your life, including paying off those loans quickly. So I don't necessarily think it's taking advantage of a poor person in that sense, because a student is agreeing to do this. I want this college degree. I'm going to take on this debt. But I think it's, I don't know that I would want to do that. But I don't necessarily think it's an example of usury, if that's what you're saying.
Well, yeah, I didn't look it up. I should have, but there's a verse about about how you can charge the foreigner interest
Okay.
in the Bible. And so kind of the other thought is, well, some of these laws were more so meant for the covenant community and not for those outside of the covenant community.
Yeah.
And so I think you could potentially apply it there.
Yeah, potentially. That Exodus 22 verse where it says, "Don't treat it like a business deal. Like just lend it to this person who's in need, and don't treat it like a business deal."
Yeah.
I think is a really interesting little clause there that there is a time and a place for business deals where you are benefiting from this. Like the Scripture is not prohibiting that in any way. So, yeah, I think as long as it's funding productive ventures, I think it's and certainly funding ventures that you can get behind too. We're not lending money to a company that's going to, I don't know, make pornography or something like that. You know what I mean? Like we're trying to keep our faith involved with this too.
Yeah. On kind of the, potentially depending on the situation, not necessarily expecting to get something back from a poor person or whatever. I did listen to a talk by Finney Curavilla at Eventide, and he kind of wrapped it up by saying, in that case, it you should look at it as an honor, because you then can legitimately say in the Lord's Prayer, "Forgive us our debts as we forgive our debtors."
That's good. That's really good. So that's our conversation on bonds. They're not exciting,
Hope you're still awake.
but they play a role in your portfolio, and they shouldn't be thrown out because of 2022.
Right. And they can be exciting.
Sure. I thought this was a riveting conversation.
I'm glad.
Good. Well, that's all we have for today, right? Nothing else?
I did want to bring one other thing up. 2 weeks ago, you made a mistake in something you said.
I doubt it.
And I said we got to roll the tape. I think I should bring it in next week. I went back and I listened, and I was 100% right. So I just want the listeners to know.
But Jesus looked at them and said, "With man this is impossible, but with God all things are impossible."
Are possible.
What did I say?
Are impossible.
No, all things are possible.
Yeah.
Yeah.
That I was right.
Listen, I know exactly what you're talking about because I listened to it too, and you're right. I did say the wrong thing, but
And then you fought me on it.
you know what I meant. You know what I meant when I said it. Anyway, yeah, whatever.
Just realized Logan's always right.
It's not, I didn't mean it that way. Clearly, I just misspoke. I misspeak all the time.
And then I challenged you on it, and you're like, "No, I didn't say that."
That's because in my mind, I said it the right way. And that's all that matters.
Okay, I just thought it was worth bringing up, just
Whatever.
so that everybody knows.
All right. Well, thanks for listening. Tune in again next week. God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.